We see this even in the simplest of eco numbers in trade data when you have great exports but imports not doing that well. Explain to us exactly what's going on.
It's a bit of a puzzle. Asia has managed the pandemic well. If you look at the number of deaths so far in COVID-19, they're orders of magnitude higher in the US and Europe than they are across Asia. And if you look at the extent to which people are moving around outside of their homes, the now famous Google mobility data, life looks a lot more normal here in Asia, I think, than it does in the US and Europe. And yet, what we're seeing is consumers in our region are remaining much more cautious than they are in the US and Europe. So retail sales growth has never really recovered back to pre-COVID levels, certainly in terms of growth rates. And we haven't seen the pent-up demand either. And that's showing up in the nature of growth and really has convinced us that it's US and Europe that's lifting Asia out of the hole rather than the other way around.
But that's been sort of a historical trend, no? That you are seeing savings across Asia being relatively much higher than the US or Europe, and US and Europe always sort of happy to get Asian financing. So how could this become a problem?
I think this could become a problem if the current account surpluses keep rising, because it means that Asia becomes over-dependent on growth in the US and Europe. That's a problem for Asia, of course, because if we did see a slowdown in the US and Europe, if, for example, the vaccine rollout didn't go quite as planned, what is Asia going to do next? And I think the talk here across much of the region, including in China, is rolling back stimulus. And I think it's too early. It's too early to roll back that stimulus because we still don't see the domestic demand coming through. But the second issue is very much related to relationships with the US and Europe. Because if Asia continues to remain too reliant on demand in those economies, that means Asia's not pulling its weight in the global demand recovery. And that, I think, will lead to some tensions going forward.
Now, your growth outlook for China is on the lower side of the consensus. Why is that?
Yeah, there's a couple of reasons for that, Paul. The first one is the consumer. We're still seeing clear evidence that Chinese consumers are still quite cautious. All of this expectation for revenge spending never really came through. I think Chinese consumers took a long time to recover from their income shock of last year. Fiscal stimulus never really touched households directly in the same way that it's done in other economies. And at the same time, we are seeing financial conditions in China tighten quite a bit. It appears the government's very focused on managing financial risk, and that's a good thing for medium-term growth. But there are trade-offs with growth over the next 12 months. So we think that China will grow at about 7%. We'll have to wait and see what the growth target is at the moment. But the current data still seem fairly consistent with that view.
It was around about this time last year that we had the PBOC withdrawing liquidity and turmoil ensued. What are you expecting this Lunar New Year?
Yeah, we think that the PBOC is going to be very keen to try and keep liquidity conditions very stable. I don't think in anyone's interests to see too much volatility in very short-term interest rates. But at the same time, we have seen the PBOC let short-term rates go up a little bit. Maybe it's a bit of a signal that tightening is coming. And for us, it's too early. I think if China does tighten monetary policy at the same time that it's going to be tightening fiscal policy, it's going to be tightening housing policies and credit policies, then there is the risk that Chinese growth could undershoot market expectations quite a bit this year.
We're going to get new yuan loans data later in the week. What are you expecting on that front? And could perhaps the Lunar New Year help when it comes to boosting domestic demand?
So we expect, a fairly modest number because this is a really key number because, of course, as we know, the economic activity data, we go into a dark period during the run-up to Chinese New Year, and we'll only get a clearer picture of the real economy in March. So the credit data are very important from that perspective. They're also really important because the bank's quotas are reopened again. So we'll get a sense of how big those quotas are for lending this year. And that in turn can help us maybe guess where nominal GDP growth is going to be. But we think that the numbers are going to continue to be fairly moderate. Just to put it into perspective, the net flow of new credit to the economy in China over recent months has been about 4 to 5% of GDP. Back in May, that net flow was close to 9–10% of GDP. So we've already seen, I'd say, substantial credit tightening, and that's going to show up in growth over the next 3 to 6 months.